Hi guys, welcome to another video from Little Too Simple. In today's video, we'll be discussing the strategies that the wealthy use to succeed at investing. From long-term investing to understanding market trends, the habits of successful investors can help everyday people like you and me accumulate wealth and build a strong investment portfolio. So make sure to watch this video till the end. One of the key habits of successful investors is long-term investing. They understand that investing is a marathon, not a sprint. Instead of chasing quick profits, they focus on building wealth steadily over time. According to a report by BlackRock, long-term investing has historically outperformed short-term trading. By taking this approach, investors like Warren Buffett and Benjamin Graham were able to weather market ups and downs and still achieve their financial goals. Another important strategy of successful investors is value investing, looking for undervalued companies with strong growth potential and investing in them for the long term. By buying low and selling high, they maximize their returns. A Morningstar study found that value stocks have outperformed growth stocks by 4.5% annually over the past 90 years. This strategy was popularized by legendary investors such as Warren Buffett and Benjamin Graham. Diversification is another critical factor for successful investors. They know that spreading investments across different asset classes and geographies helps reduce the impact of market volatility and minimize risk. According to BlackRock, a diversified portfolio can help investors achieve long-term financial goals more effectively than one focused on a single asset class. Successful investors like Ray Dalio, the founder of Bridgewater Associates, built their careers and fortunes on the principle of diversification. Wealthy investors also explore alternative investments such as art, private equity, real estate, crypto, hedge funds, and commodities. They believe that diversifying into alternative assets increases their portfolio's return potential while reducing overall risk. If you'd like to learn more about alternative investing, today's your lucky day. We have an entire video dedicated to this topic. Click the link on the top right corner of your screen to watch it. Successful investors know the importance of research and due diligence. They conduct their own research and thoroughly analyze potential investments before making decisions. This allows them to make informed choices aligned with their strategies and goals. A CFA Institute study found that investors who do their own research tend to outperform those who rely on others for information. Investors like Charlie Munger and Seth Klarman are known for their exhaustive research and careful analysis. Understanding market trends is another critical factor for successful investors. They stay updated on financial news and economic developments to make informed decisions. They also understand how different industries and markets are impacted by changes in the economy. By staying informed, investors like George Soros and Paul Tudor Jones have been able to identify opportunities early and minimize risks effectively. Building relationships is also an important part of investing success. Successful investors maintain a network of professionals and experts who can provide insights, guidance, and valuable information. They also build strong relationships with other investors to share ideas and learn from each other. A study by the Wharton School of Business found that investors with strong networks tend to achieve better returns than those without. Investors like Stan Druckenmiller and T. Boone Pickens have benefited greatly from their extensive networks in the investment community. Many successful investors also work closely with finance professionals such as investment advisors and wealth managers. These experts provide access to unique opportunities and help build diversified portfolios. By working with professionals, investors can increase their chances of success and achieve their financial goals more efficiently. Wealthy investors understand the importance of managing risk. They know that every investment carries some level of risk, and they take steps to control it. They develop a well-defined investment strategy and stick to it even during volatile times. According to the National Bureau of Economic Research, investors who effectively manage risk tend to achieve better long-term returns compared to those who don't. Successful investors also have patience and discipline. They understand that investing is a long-term game and don't let emotions dictate their decisions. Even during turbulent markets, they stick to their strategy and stay patient as their investments grow. This discipline allows them to build wealth steadily and reach their financial goals over time. To give you an idea of what successful investing looks like, here are a few examples. Warren Buffett, CEO of Berkshire Hathaway, known for his value investing and long-term approach. His portfolio has delivered about 20% annual returns for over 50 years. Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds, known for his principle-based investing and risk management strategies. George Soros, founder of Soros Fund Management, famous for his macroeconomic investments and ability to generate high returns in currency and stock markets. Successful investors share a number of habits and strategies, from long-term investing and value investing to diversification, research, understanding trends, building relationships, working with professionals, managing risk, and having patience and discipline. These are the key ingredients to achieving success in the world of investing. So, keep these strategies in mind as you build your own investment portfolio. And remember, success in investing takes time and dedication. Thanks for watching, and see you in our next video.